Hello everyone, welcome to Property Finance with Lee. I hope you all had a great Christmas and New Year. No doubt, some of you spent big over the Christmas break. It's something we all do between buying presents, going away for holidays, even being without work for a couple of weeks. We tend to give the credit card a workout and dip into our savings. In today's video, I'm going to talk about starting the year fresh and how to go about consolidating those extremely expensive credit cards and personal loans. If you're new to the channel, I'm a mortgage broker who talks all things property financing and investing. So, hit the subscribe button and turn on notifications to keep up with my latest content. Let's jump in. I feel like everything went up last year. I spent a lot of time talking about the cost of living and showing you guys how much inflation has affected prices. Honestly, I think some things in the shops have doubled. As such, it has been extremely difficult to put savings aside over the last 12 months. No doubt, over the year, and especially the holidays, some of you guys have racked up a credit card bill to get by or used a personal loan to buy something big like a jet ski for the summer. More than likely, this debt is on a high rate. So what can you do about it? Assuming you can't pay these debts off in cash, we are left with a couple of options. We can consolidate the debt into a cheaper unsecured loan, for example, moving a credit card from an interest rate of 18% to a cheaper personal loan. However, this option is still expensive. Another option is to refinance the debt within your home loan through a debt consolidation mortgage, also known as a cash out refinance. There's a couple of ways you can do this. One way is to redraw on your existing mortgage if you've made extra payments. Another way is to refinance and in the process, pull some cash out of the loan to cover these debts. Back when you first bought your place, you likely contributed a down payment and over time, your property's value has grown and you've chipped away at the loan balance. Your equity has grown in the property over this time. With a cash out refinance, you're tapping into the equity you've built up to increase your loan size and use those funds to pay off more expensive debt like your credit card. Where you were paying 20% interest on a credit card, you can now be paying as low as 6%. The thing to remember is, with a debt consolidation mortgage, you're not wiping out debt, you're reshuffling it. You're bundling up expensive debts within your new mortgage. Why go through this? There's a couple of reasons. The biggest reason is swapping debt from a high interest rate to a lower interest rate will cut costs. There's a good chance a credit card's interest rate could be in the range of 15 to 20%. And the reason they are expensive is because they're unsecured debts. A mortgage is a different beast. Mortgages have much lower interest rates. Currently, we're talking around the 6% mark. This is because it's a secured debt. If push comes to shove and you can't make those mortgage payments, a lender can repossess the property and sell it to regain their funds. The debt's tied to the property, and lenders know it's the last thing people will default on. And if worse comes to worse, the lender has recourse should things go wrong. That's really the reason why an unsecured debt like a credit card has a high interest rate, and a mortgage, which is secured against the property, has a lower interest rate. The other benefit of this is that instead of juggling your mortgage payment and a couple of credit card bills, you simplify things to a single payment you need to make. When we find ourselves paying many high interest debts, things get dicey, and perhaps a debt consolidation mortgage with the goal of swapping out high interest debt for a lower interest mortgage will save you money and give you some much needed breathing space to chip away at your loans instead of using those funds to pay interest. Let's use an example to illustrate how this works. Suppose your property is valued at $600,000 and you've paid down your mortgage balance to $450,000. We know that to keep within 80% LVR, the maximum lending we can have against the property is $480K. If we remove the outstanding balance of $450K from $480K, we have $30K in available equity that we can cash out. However, you need to be disciplined when you do this. Converting short-term credit like a personal loan or credit card debt into a lengthy 30-year mortgage isn't the smartest move if you're not planning on paying extra towards getting that specific amount paid down quicker. And what I mean by this is, imagine you come to see me and you haven't had a home loan health check in the last 5 years. So it's probably a good time to have a look at your mortgage anyway. We end up refinancing, I'll save you some interest there, and I'll also refinance your 10K credit card and 20K personal loan for the jet ski you bought this summer. Let's imagine both debts had a 5-year term at a 15% interest rate. Over the course of 5 years, this would have amounted to $12,822 in interest paid. That's insane, and you're smart to refinance it. At a 6% mortgage over the same time, the interest charge would be $4,799. That's almost the initial cost of the credit card itself just in interest. The savings are huge. However, sadly, studies show that more than 80% of people will not make extra payments specifically for those debts. Instead, they will come to see me, refinance, save money on their interest rates initially, and then take out another credit card debt and purchase a boat to match the jet ski the following summer. Just to show you how detrimental this is, if we refinance two debts which amount to 30K and we don't pay anything extra and keep it within the mortgage for the full 30 years, instead of making a saving of around $8,000, the interest cost is $34,751, almost 3 times the amount than if we had just left it alone at a 15% interest rate. The smart move, if you take on a debt consolidation mortgage, be disciplined with yourself. Take that credit card debt, bundle it in your mortgage, and keep making payments akin to what you were tossing at the credit card before refinancing them within your mortgage. This will accelerate paying off your debt much quicker, ensuring your mortgage balance shrinks faster. The key is not to dump the debt into the mortgage and forget about it. That road leads to paying far more interest than you otherwise would. Guys, I've been very clear so far about refinancing one-off expenses with the intention of paying them down within their original loan term, but on a cheaper rate. If you find yourself wrestling with debt that you feel is weighing you down and that you can't escape from, I want you to understand that a debt consolidation mortgage is not a magic fix for your predicament. Take a moment to think about how you ended up within the clutches of credit cards or personal loans to begin with. If it's an ongoing problem, hitting the cash out refinance button isn't a cure. It's merely a band-aid solution for an existing wound. If overspending is the reason, make a budget you can stick with, or speak to a financial planner and dig into budget management strategies to trim down your expenses. Consolidating unsecured debt within your mortgage should be done with foresight and a commitment to a debt clearing lifestyle. Not used as a hasty solution to toss debt into a mortgage and forget about it. If your debt stems from one-off major expenses like the jet ski we talked about, or tax debt, or perhaps a business expense, a debt consolidation mortgage could be great. But if it's all about spending money on clothing or personal items, it will most likely do you more harm than good. Planning, discipline, and commitment are key here. That's it for today, guys. If you have a high interest debt you want to refinance, or perhaps even save money on your mortgage, feel free to contact me from the details below. I wish you all a great year ahead. Thank you for joining me today. Catch you next time.